Okay, let's talk macro because we have a couple things to talk about when it comes to the macro. So here's the first thing I want to talk about. This is a report from Bloomberg Intelligence in terms of what Trump is trying to do here with the 10-year and what Scott Bessent, his Secretary of Treasury, are doing as well. These guys do not care about the dollar. They care about the 10-year yield. That is the number one thing they care about. They also don't care about the Fed. They care about the 10-year yield. Amit, are you buying more Tesla? Yes, I bought more Tesla last night. And tonight, given how bad it could get, if it does get bad, I'll buy more Tesla today. So here's what Scott Bessent said. The Treasury Secretary says the Trump administration focuses on bringing down the 10-year yield, not the Federal Reserve's benchmark short-term interest rate. They also believe that expanding energy supply will help lower inflation and that reducing the budget deficit will help bring down the 10-year yield. And the administration's goal is to achieve non-inflationary growth, with Bessent supporting making the 2017 Tax Cut and Jobs Act, which was the original DJT tax cut, permanent to continue U.S. economic growth. I think they will get the tax cut because they have the Senate and the House, so they're probably going to get that passed. Along with the executive branch. But then if you're going to have lower taxes, you're going to have increased growth, which means you're going to have more inflation as just a byproduct of economic theory, which means you need to have something that can lower costs across the economic sector, right? Whether that's housing, oil, whatever it may be, to get that 10-year to come down. And they are focused on doing whatever they can to get that 10-year down. Now, you may be asking, okay, oil, we heard, drill, baby, drill. That's one way to get the 10-year down. Independent growth from different areas that could lower prices. So if you just have more eggs, maybe egg prices come down, right? I know we have crazy egg inflation right now, but if you can increase supply, increasing supply as a function of demand would maybe lower prices. But the number one thing for what I think Trump is going to do to try to get the 10-year down, and I think Elon knows this as well, is Doge. If Doge could get government cuts or government costs to come down, Elon has an argument that he believes government costs could come down to the tune of $1 trillion by the end of next year, which would be half of the deficit or half of part of one of their deficits coming down. Then that signals to the bond market, okay, this administration is very serious about getting costs to come down. And even though we do have certain types of inflation that are creating headwinds, if you're spending less money in the government, which could have an impact on growth, but that's a whole nother issue in terms of how to balance, you do have less stimulus. And if you have less stimulus, theoretically, you should have less inflation as well. So there is an argument that the bond market, and you guys might be asking, well, why has the bond market been down so much over the past couple of weeks? One of the reasons is because of Doge. I mean, CPI was good, core PCE was good, but tariffs have been incredibly inflationary. And when Trump announced tariffs, like when he was gung-ho that he was going to do it, there was no move in the 10-year. It was almost like the 10-year was balancing the potential stuff that Doge could do in terms of cutting costs in order to weigh against the tariffs that Trump would implement, which now we know that Trump's not even implementing a lot of those tariffs. And some people might be skeptical about this and saying that the bond market's not paying attention to Doge, but I disagree. I think based on the tweets that Elon's putting out about Doge and how much money they're saving, he's getting a lot of people's attention around the idea that the bond market, or that we are going to take fiscal spending a lot more seriously in terms of reducing it. And as a result, the bond markets are saying, all right, well, if that's the case, let's lock in our yield right now, right? Because we're not going to say that inflation goes higher if Elon's serious about this. And why do I think Elon's serious about this? Well, a new report came out from the Wall Street Journal yesterday, and this is crazy, dude. X reported to the investors in 2024 adjusted earnings before interest, taxes, depreciation, and amortization of $1.25 billion and annual revenue of $2.7 billion. This is why Morgan Stanley, Goldman Sachs, people that own X debt, formerly known as Twitter, they were able to sell it on 97 cents on the dollar, which is not a bad return if you're selling off your debt. Elon doubled Twitter's EBITDA, and he grew their margins from 13% to 46% since he bought X. Chris, I'm sending you the StreamYard right now. I see you in the chat. I'm going to send you the StreamYard right now, which is insane. It is absolutely insane. So the fact that Elon was able to nearly triple their EBITDA margins and then actually get to EBITDA positive, even if they're not net income positive on like a quote unquote GAAP basis, allowed the bankers to sell off the debt they bought in 2022 that was really referred to as debt that would be down at least 50 cents on the dollar for 97 cents on the dollar. So from that perspective, I think that is why the 10-year is acting the way the 10-year is. Look at the 10-year. It's well under 4.5. It's at 4.43, dude. I mean, we can get this bad boy to 4%. We are going to have fun in the equity markets. But the only way to do that is if the market believes that inflation is not a concern. And the only way for them to believe it's not a concern is either we have a labor market that collapses, aka a recession, which would definitely send the 10-year down, but that's not, the right way to send the 10-year down. Or you have Elon come in and every single day he puts out a tweet to 200 million people saying, yeah, we cut this, we cut this, we cut this. We're buying out these employees are gone. We're getting rid of these federal workers that aren't doing anything. We're shutting down this business. We're shutting down this building that houses people, but the federal workers don't even come in for work. And he compounds all of these losses and essentially turns them into profits for the federal government by not spending them. And then boom, you get the bond market that gets a little bit more exciting. So look, is that going to happen? I don't know. I'm just the messenger here on what I think the bond market is perceiving when it comes to Doge. And if Doge can actually execute, which is yet to be seen, there's a world where Trump could get away with a lot of his pro-growth policies that could be inflationary because the government's just not spending as much, which would be kind of a Goldilocks zone for Trump. Chris, good morning. How are you?
Good, man. I am so glad you brought up the topic because I think that's probably one of the smartest moves ever, dude. So, and let me just show all the viewers exactly why. The reason why the 10-year is important is because if you look at the 30-year mortgage, which is what most people tend to get for their homes, look at the correlation here to 10-year treasury, right? If you look at the 10-year treasury, as the yields go down, so do the mortgage rates. And as yields go up, so do the mortgage rates. They're almost constant, that there's a spread between there. Usually it's about 1.5 to 2%. So if you get 10-year treasury to be like 3%, right? That means that now you can issue mortgages at 5%. So that's huge for people looking to buy homes, right? The reason why that's important is because right now there's a huge lock-in of people that want to buy a new home, move, whatever, but they're not putting homes on the market because they're locked into a 3% mortgage. But as you get interest rates lower, the amount of inventory is going to actually go up. So if you look at this right here, let me stop sharing this and just share the other screen. Shelter inflation has been one of the leaders when it comes to inflation reduction. So look at this. Inflation is coming down significantly, but it's sticky, right? It's not moving down fast enough. So right now, shelter inflation is about 4.62%. If this does not move at a rapid pace down, what ends up happening is businesses, consumers, everyone starts to kind of expect inflation to remain higher for longer, which almost keeps things higher for longer. So let's say right now you're doing a labor negotiation, right? With a union, the union says, hey, listen, my members, they need a 4% rise because that's what the current inflation is. And, a lot of employers are going to have to relent. Right. But that's what happens. The expectations are what lead it. So right now, if the Scott Bessent can get this to be controlled, the 10-year to go down, it's going to do a few things. Number one, the 30-year treasury will come. The 30-year mortgage will come down, which means a lot of people that are in 3, 4, and even 4.5, maybe even 5% mortgages, they're more likely to put their homes on the market because they need to move. Yeah. Right. Yep. Think about all the people that bought homes during COVID, thinking they're going to work from home forever, and now they're being asked to come back to the office. What do you do with that existing property? So the inventory is starting to creep up in certain parts of the country. And I think that's going to end up playing into the shelter part of it. And so I think right now they're making the right move. With one side, they're trying to reduce they're literally using Milton Friedman's playbook of cutting expenses to get inflation down. The federal government, as they start cutting interest rates, inflation should come down. The 10-year treasury, because you're so proactive with reducing down expenditures, that the bond market is responding by lowering that 10-year treasury. And that downward movement in 10-year treasury will then boost up the demand for mortgages and stuff. So basically it's kind of this Goldilocks scenario that these guys are trying to engineer, but I think it could be done. I'm actually very optimistic about it.
Well, do you think that the 10-year genuinely believes that Doge can cut expenses? And that's why
I think it's a combination of two things. Number one, it's the expense cuts from Doge, but at the same time, it's that jawboning from Scott Bessent saying that no, the 10-year is going to be a focus. Our focus is going to be a cost cutting, right, across the board. I think that will lead people to say, you know what, maybe I need to buy more treasuries. You know, because right now, I mean, technically speaking, that is not a bad way to hedge right now against an overvalued market. Right now, if you look at the stock market, valuations are high. So a lot of people, they're ignoring bonds. But dude, there's actually value in being in bonds as it goes down and down, you know? So
and I also think Elon's like really pounding the table on some of the stuff that they're cutting. If he continues to really cut aggressively, and they've already done like almost $30 billion of cuts, I think the bond market might take him a lot more seriously. We saw Brad Gerstner basically echo the statements of Elon around how we need to cut our deficit. And he's an investor, right? So he's looking at the bond market, the stock market. So I do think the market's taking notice of his tweets every day to 200 million people around Doge.
Well, there's another huge benefit too, because if you are able to get the 10-year to come down and there's actually demand on the 10-year side, you can reduce down the deficit. Right? Because now the new bonds that you're issuing, you're not issuing them at higher interest rates. You're issuing them at lower interest rates. So if you're doing that, you're basically reducing down the deficit at the same time. Imagine right now we can go back to the bond market, you know, issuing debt at like 2-3% again. That would help tremendously for the federal government to get its deficits in check.
Yeah. Chris, while I have you here, I know a lot of people have been wondering your opinion on the Googs down about 7% from earnings. Was this justified or not?
I think a lot of people got freaked out by that $75 billion capex. I did not expect them to go that hard, but it also leads me to believe that there's probably a crap ton of demand, you know? So, I mean, no one's like, Google is not the type of company that's going to say, yeah, let's just invest for no reason. No, they see the demand and they brought that up. One of the reasons why their cloud growth numbers didn't expand out as much as like they were, you know, a lot of the estimates were saying is primarily because they were capacity constrained. So they're correcting that by adding a ton more GPUs and data centers, and that costs money, you know? So the challenge though, and this is one thing that's probably going to come up in the first quarter, where the first and second quarter might end up being a little bit weak because of two things that they described. One was currency headwinds from a strong dollar, because remember, they're generating money outside the United States also. Right. And so if you translate it to the dollar compared to last year where the dollar wasn't as strong, you have to adjust for that. So FX, there's some headwinds there. And then there's also 1 day less in the compared to last year. 2023, we had a leap year, so we had an additional day. But one thing is, look at this. Everyone is raising their price targets. So for me, I think this is a great opportunity. I'm going to be adding to my position. Google's a great company. Businesses are phenomenal, you know. So, yeah.
Yeah, almost all of these guys raised their, I mean, no one came, it's not like AMD where the reaction was, all right, we're going to lower the price target. We're getting a little iffy. This was like, they're spending more on CapEx. It is what it is, right?
Yeah. Yeah. I mean, this is really bullish for NVIDIA, Broadcom, even the other ones like SMCI, because the thing is, a lot of people thought after DeepSeek, a lot of these companies would start cutting back on CapEx. But from what we're seeing right now, Meta and Google have already said, we're expanding our CapEx. Now, Amazon's going to come out next. If they say we're going to expand our CapEx too, then you got yourself a trifecta, man, you know?
All right. So last question for you, preview on Amazon. Do you think they have the same fate as Google, or you think they pick up the cloud slack in AWS?
I don't know. This market's just weird, dude. I have no idea. You know, Meta did a really good job of saying that they were going to spend a lot of money beforehand. Google was a little bit like out of left field. So that's why maybe the market reacted in a not so positive way. Also, the growth estimates on their cloud might have been a little bit too much. I mean, I personally was also very bullish on cloud growth on Google. I had no idea that they were capacity constrained, you know, but that's what happens sometimes. So, yeah.
Are you, shout out to Farzad in the chat. I'm going to ask this question to you just because Farzad's here. Are you buying this Tesla dip?
No, bro, I'm good. Y'all can buy as much Tesla as you want. I'm not in Tesla. I'm not in Palantir.
If I go below 100, you have to buy the dip, Chris. You have to.
No, thank you. I'm all right. I'm all right, guys. Y'all can have all the Palantir that I miss out on. You know, I'll stick to what I know.
All right, Chris. We
All right.
appreciate you, brother. Thank you for being on. Talk to you next time.
Later. Take care.
Shout out to Farzad, bro. Shout out to Farzad. Look, I think Chris made a lot of sense right there. If Bessent can get this damn 10-year lower, and again, you don't have to believe in what Elon's saying, but the 10-year and the bond market is absolutely not taking it for granted that Elon is pretty headstrong or headfast on getting cuts to come in terms of overall government spending. And they've shown a bunch of stuff on their Twitter account of different things they're doing that are verified to be true in terms of different cuts. I mean, I heard a report yesterday. Let me see if I can get the exact report that 50,000 people are taking Trump's offer for the buyout. That was basically Elon's idea of like, let's just buy them out and move on from them. So I'll get the exact number here, but I believe 50,000 federal workers are taking up that buyout offer. If that's the case, the bond market's like, okay, wait a second. So 50,000 people that were theoretically being unproductive, and we can trust that they were being unproductive because Elon is one of the smartest entrepreneurs in the world who probably knows a little bit about what it means to be productive. If he's giving them a buyout offer and these guys are leaving and he's going to replace them with maybe 10,000 people out of the 50,000 that are voluntarily deciding to leave, there is an argument here that Elon's going to give more productivity to the government, and that productivity is going to come with decreased costs. And if that happens, you're going to have a little bit of room in the deficit that gets to be positive. And look, this was never going to be easy. No one ever thought it was going to be easy. And quite frankly, I was skeptical that Trump or Harris would actually take any realistic steps to reduce the deficit. But if Trump's letting Elon do what he wants to do, and Elon has a shot to actually decrease certain parts of the deficit, you're just going to get a lot more people that are excited about the Feds not spending as much money. And as a result, that's going to bring that 10-year down. Yeah, this was the Washington Post report yesterday. 40,000 federal employees have now accepted President Trump's buyout resignation offer. I don't know what was the condition to not accept the buyout. I think the headline was you have to show up in person to work, or I don't think they're like offering less pay or something. It was just like certain things that you have to do. And I guess 40,000 federal employees are deciding they'd rather take the buyout. I mean, look, dude, Elon cut 80% of Twitter in 2022 or 2018. I think he sent that email to Tesla employees that this is a fork in the road, and you either got to be good or you got to be you got to be either great or you got to get the hell out of here, right? And if he's saying the same thing for the government, that is a totally different paradigmatic shift that we haven't experienced in the United States government in a long time. And whether you like it or not, that could help be one of the reasons for why inflation comes down and we get to keep up growth. So it's going to be important. It's going to be very, very important. 40,000 out of how many? I don't know. I would imagine there's millions though. So it's a small amount in terms of the overall employees that were offered the buyout. I got to do some more research on it today. I haven't looked into like what exactly Elon offered. Like I actually want to read the email, the buyout offer. I want to see if I can get through that stuff today. But if it's helping us decrease inflation, then I think that is a good thing at the end of the day. So he can push his robots. I don't know if robots are going to be doing some of these federal employee jobs, maybe, but you never know. Farzad said 2 million federal employees. Could you imagine if robots are walking around the IRS and doing stuff? Okay, speaking of robots, here's why I bought 10 shares of Tesla last night at 12 a.m. Here's why I bought it. I bought it off one tweet. And this one tweet that I saw reminded me why I wanted to start buying Tesla this year in the first place. Sometimes you need a little bit of a reminder, and this was my reminder. Tesla is now officially hiring engineers to prepare for mass production for Optimus in their Fremont factory in California. Here's what one of the Tesla LinkedIn employees said. My team is turning Tesla Bot into a reality. We're building Tesla Bot in our Fremont factory in California, and we're looking for engineers up for the challenge of getting this product ramped for high volume production. That was all I needed, bro. Because Tesla come lower short. Could Tesla go back to 300? I don't know. Maybe it could. But this was the reason that I got excited about Tesla like late last year. And I mean, like if they are officially getting ready to start scaling production for the bot, I am pretty convinced that the unit economics on the bot are something that we have never seen as a humanity. And I think it can be well into the trillions. And if that's the case, then I think there's simply going to be a ton of momentum in this ecosystem. And as a result, Tesla's getting ready to ramp up for that. So, I mean, that's my thing. That's my constant DCA into Tesla. It's going to be based on this thesis that the bots are coming And FSD is kind of a cherry on top. The automotive business is hopefully does well this year, but it's the bots. It is the bot. I don't think we can put a price on what those look like. Now, is Elon's timeline aggressive? 2026 shipping out, or I think 2027 shipping out 500,000? Yeah. But if they're getting ready to hire to start high volume production, maybe they're going to live up to at least somewhat of those expectations, even if it's not 500,000. And I don't think the street has factored that in yet. And I think a lot of us are going to be, when this thing is $600-700 and the bot thesis is so obvious, and it just like Palantir right now that it's 100, the street's upgrading it to 110, 115. It's like, it becomes so obvious after the fact, but it's hard to buy it in the short term when it's not obvious, but that's the best time to buy, right? So that's kind of my thoughts on Tesla. Tesla's been having a kind of crappy week. I don't know really why Tesla's been down. I mean, maybe it's just the earnings lag that's catching up to it, because the earnings did suck and Tesla probably deserves to get hit a little bit from those earnings. But the fact that it's even holding the 350s, I think, is impressive. And so I guess throughout the rest of the month, we're going to see where Tesla goes, especially after Amazon. Farzad, oh yeah, I remember Farzad. This was your first call option, right? Farzad bought a 710 strike. I think if this was like 5 months ago, Farzad, you bought like a 2-year 710 strike, and this was your first call option ever. So Farzad's a little a little bullish on where Tesla's going in 2 years, in a long time. Yeah. What's June 2026? Okay, so look, I don't know if Tesla gets to 710 by June 2026, but if it gets there, would any of us be surprised in that's what, basically 2 years, 2.5 years? No, 1.5 years. So 18 months. In 18 months, if we are, and we don't have to be in 710 for Farzad to make money on that. I mean, if it gets even 500, he'd be up on that call, or 600. But yeah, I wouldn't be surprised, bro. Especially if the street starts pricing in robots before robots happen, right? So the perception of robots would be what the street prices in. We do have Trump speaking right now. Let's go over to this and hear a little bit of what he's saying, and then we'll get into the market open in just 6 minutes.
Liquid gold coming out of the ground than anybody's ever seen before. We're going to drive the price down, and everything else is going to follow. So he's one of the really important people. He's a very, very, very great gentleman, was a fantastic governor, by the way, and really did do, and for sort of learned the oil business as a governor, because he made his money, made a lot of money, which I like. I like people that make money, because that means they can help us. And they always like me to put in really people that have failed. They want.
Okay, so it's not like any like specific press conference or policy meeting or anything. He's speaking at the National Prayer Breakfast. So probably we'll talk about some political stuff, but it's not like a news conference or anything like that. Trump did sign a bunch of executive orders yesterday. So we had some of that news. We also had some of that crypto executive stuff that happened a couple days ago. But overall, no major policy updates yet from the administration outside of the ones that we saw on Monday and Tuesday around the executive orders for sovereign wealth funds. Now, we do have some updates in terms of the Panama Canal, and that came out a couple days ago as well, that they're now allowing U.S. Navy ships to pass free of charge. So that's one thing that is good. No changes in terms of the China tariffs. Those negotiations are still going back and forth. Xi Jinping and Trump, I believe, did talk a couple days ago. And we got to see what the update is from that. But or they're getting ready to talk today, if I'm not wrong. But they haven't come to a Trudeau or Mexico type of deal where they delay the tariffs for some type of concession. Robinhood right here in the pre-market is 55. There you go, 55. It's great to see. It's great, dude. I think Hood's going higher this year. I think it really is crazy, bro. Robinhood's not Palantir, but it is having a bit of a Palantir moment in terms of, I don't know if it's going to go crazy stock price type of Palantir action back up to 100. But the street is realizing that you bet on the winners, you bet on the founders, you bet on the ones that are growing, you bet on the ones that are executing. And in the fintech space, it's Hood. Like there's just no one else that's doing it like Hood. And in the software space, there's no one else that's doing it like Palantir. And as a result, you're getting there. I know Robinhood is still market contingent, so I don't want to get super euphoric. Obviously, if we have a couple bear months, that could really hurt Hood. Bad months for crypto, that could hurt Hood. But I believe in their innovation and their product suite to be able to outweigh that, overcome that. And I think the street does as well. And that's why we're seeing some momentum here on Hood. Q4 earnings next week, Tuesday. It'll be fun. Q4 on Tuesday. That will be fun. Oh, yeah. What did Bank of America say? So let me pull this up right here. Bank of America, by the way, this is the Goldman inflation tracker. They're saying inflation's coming in pretty much at 2%. So if you look at, they put this out this morning, their core inflation tracker says that we believe inflation is coming down very nicely. And it's getting very close to being almost exactly at 2%. Dude, if that's the case, it's just hard to be bearish equities. It's hard to be bearish equities when inflation is coming down and the Fed is inevitably going to cut rates because you can't have the federal funds rate more than double the current interest rates. Here's what Bank of America said. They remain positive on Hood and IBKR while maintaining a cautious stance on Schwab. The firm expects solid U.S. GDP growth for 2 to 2.5% in 2025 and 2026 with inflation above 2.5%, creating a favorable environment for brokers with high interest rates, slowing cash sorting, and accelerating retail engagement. And they recommend Hood and IBKR while they keep an underperform rating on Schwab because there's unattractive cash sweep rate and a weak organic growth. So Schwab, much bigger than Robinhood in terms of client assets, 10 trillion versus Hood's barely 200 billion, but Hood is growing, IBKR is growing, and in the markets, you really need to prove growth to be able to get a multiple, and that's why Bank of America is bullish on them. So I think that also probably helped Hood get some love yesterday.